A new IRS rule is quietly putting thousands of dollars back into seniors' pockets, and most have no idea. It exists, let's be honest. Most tax news is easy to ignore. It comes and goes, and rarely does it actually move the needle for everyday Americans. But what we are covering today is different. There is a new IRS provision sitting quietly in the tax code right now, and if you are 65 or older, it could put a serious amount of money back in your pocket. We are talking thousands of dollars, and the vast majority of eligible seniors have never even heard of it. It is called the Senior Bonus Deduction. And before your eyes glaze over at the word deduction, stay with us, because this one is worth your full attention. The IRS is not going to remind you. That is what this channel is for. Like, subscribe, and make sure you never miss a provision that puts money back in your pocket. Here is what makes it different from the usual tax tweaks. This deduction does not replace anything you already get. It stacks on top. You still receive your regular standard deduction. You still get the existing age-based addition for being over 65. And now, on top of both of those, comes this new bonus. Think of it as a third layer, each one building on the one beneath it. That stacking effect is exactly what makes the numbers so significant. So what does it actually look like in dollars? For a single filer aged 65 or older, here is the math for 2026. The standard deduction sits at $15,750. Add the $2,000 age-based addition. Then add the new $6,000 senior bonus. That brings the total to $23,750. Nearly $24,000 of your income is sitting below the federal tax threshold. Before you owe a single dollar. For married couples where both spouses are 65 or older, the numbers get even more impressive. The standard deduction of $29,200 plus $3,200 from the age-based addition, plus $12,000 from the senior bonus, $6,000 for each spouse, adds up to a total deduction of $44,400. Over $44,000 of household income, shielded from federal taxation. For retirees carefully stretching their savings, that is not a small thing. That is genuinely life-changing relief. And here is a feature that even tax professionals call unusual. Most deduction structures in the tax code force you to make a choice. Either you take the standard deduction or you itemize. Not both. This provision breaks from that entirely. The senior bonus deduction is available regardless of which method you use. Standard deduction, itemized, it applies either way. That flexibility dramatically widens the pool of seniors who benefit, and it is one of the reasons this provision stands apart from routine annual adjustments. To put the real-world impact into perspective, if you are in the 22% federal tax bracket, a $6,000 deduction means roughly $1,320 stays in your account. That could be a year's worth of Medicare premiums. It could cover prescription costs, a home repair, or an unexpected bill. For someone on a fixed retirement income, that money matters. Now, there are income limits, and this is where you need to pay attention. The deduction was designed for low and middle-income seniors, so higher earners will see it reduced. For single filers, the phase-out starts at $75,000, and the benefit is gone entirely at $175,000. For married couples filing jointly, it begins fading at $150,000 and disappears at $250,000. The formula is simple. For every $1,000 of income above the lower threshold, the deduction shrinks by $60. What that means practically is that even if your income falls within the phase-out range, you are not necessarily shut out. A partial deduction is still a real deduction, and it still translates into real savings. Knowing exactly where your income lands relative to these thresholds is the essential first step. There is also a misconception going around that needs to be addressed head-on, because it is leading some people towards serious planning mistakes. Some are claiming this deduction completely wipes out taxes on Social Security benefits. That is not true. The rules governing Social Security taxation have not changed. What this deduction does is lower your overall taxable income, which may, and as a side effect, reduce the portion of your Social Security that gets taxed. But it does not make those benefits automatically tax-free. Assuming otherwise could result in a costly miscalculation when your return comes due. So how do you actually claim it? 3 steps, and none of them are complicated, but all 3 are necessary. When you file your 2025 tax return in early 2026, use Form 1040-SR, the version of the federal return built specifically for seniors, with larger print and clearer formatting. On that form, check the box confirming you are 65 or older. That single check mark is what triggers your eligibility for age-related benefits, including this one. Do not skip it. Then, complete Schedule 1A, the new form where the senior bonus deduction is formally calculated and claimed. Without that schedule, the deduction will not appear on your return, no matter what. Most tax software will handle it automatically. But if you work with a tax professional, bring it up directly and make sure it is not overlooked. Here is perhaps the most critical thing to understand about this entire provision. It has an expiration date. The senior bonus deduction applies only to tax years 2025 through 2028. After the 2028 filing season, unless Congress extends it, it is gone. That gives you a defined 4-year window, and the seniors who plan around that window deliberately, rather than stumbling across it at tax time, are the ones who will get the most out of it. One last thing before we wrap up. Whenever a new tax benefit surfaces, so do the scammers. You will likely start seeing unsolicited calls, emails, and offers from people claiming they can secure this deduction for you for a fee. Do not pay anyone. Every form needed to claim this benefit is available for free through the IRS directly, and reputable tax software will do the work automatically. This benefit is already yours. No one needs to be paid to unlock it. The bottom line is this: rising healthcare costs, long-term care expenses, and the daily pressure of living on a fixed income have placed real stress on an entire generation of retirees. This deduction was designed specifically to ease that burden, even if only temporarily. But a deduction that goes unclaimed helps no one. The window is open. The forms are ready. Now you know it exists. Make sure you use it. That brings us to the end of this video. Thank you for watching. If you found this useful, like the video and subscribe.